A very good afternoon, good morning, everyone. I really appreciate everyone's patience today. We were having some technology issues today, so things were a little bit delayed. But welcome, everyone. I am so thrilled to be here because what we are going to cover today is going to change your thinking, how you think about taxes for forever. Okay. And most business owners think taxes are just something you pay today and forget about it. And then when it's time to pay again next year, we will think again next year, go through that same stress. And we go through that same stress again and again and again. And we don't do anything to change, right? So I'm going to show you how they can become a tool for your wealth building. And I'm also going to cover today a little bit of a teaser on a big, beautiful bill that passed on 4th of July as well. So, just to give you a little bit of a teaser on that side. If you all can hear me and see me, just maybe give me some thumbs up or send me message in the chat so I know that it's all working good now. Okay, perfect, perfect. Thank you so much, everyone. Alrighty, so without further delay, let's dive in. And I'm going to make sure to reserve some time towards the end of the master class to go over some live Q&A. And in the worst case scenario, if we run out of time, then make sure to put your questions along with your email address, and I'll personally get back to you within 24 hours with answers to those questions as well. Okay, so here we are. Have to legally save tens or hundreds of thousands in taxes before your next quarterly payment. And we will also go over the One Big Beautiful Bill Act and some time tested, court approved strategies that could save you somewhere from $30,000 to $100,000 this year and every year moving forward. How about that? Um, okay, so let's move on to the next one. Oops. If you have ever felt like this, you worked hard, I'll tell you my personal story. I grew up watching my father working harder than anyone I have ever met. And no matter how much hard he worked, hustled, there was never enough left. So my mother never went to school, as a matter of fact. And in fact, she was the CFO of our family, our house. She stretched every single dollar to give us the life that we are enjoying right now and give us the chance that she never had personally. We didn't celebrate any birthdays, we didn't go out. Everything was mainly about survival. And when my friends had their parents cheering them on at school events and, graduation and everything, my parents were working, always working. And, at 17, I was told no, when I approached my dad, I wanted to, study about further in the CPA field. In fact, my both the parents never went to school, so they were not educated. And Taruna, who happens to be my elder sister, she was the first girl in the family on both sides to study beyond the high school, beyond 10th grade. And I followed her footsteps. But when I said I wanted to become a CPA, my father said no. Not because he didn't believe in me, but because fear was louder than hope. He was scared. What if I failed? And what if I got married and my husband's family didn't allow me to study further? And in our family, the old belief was don't invest in daughters, they'll just get married and leave. And but I couldn't unsee the future I felt in my bones. So I cried literally for 4 days because I knew this was my calling, this was my path. And eventually, my father saw the conviction in my eyes and he said yes. And together, we didn't just change our lives, we changed the trajectory of our entire family. Sometimes it only takes one brave yes to break generations of quiet no's. Um, you know, why we became more than just CPAs. I became a CPA and I was proud. But very quickly, I realized something shocking. Most CPAs aren't trained to help clients with their money. Most CPAs, sorry, my mouse is working really, weird on here, but I hope you can see the screen very well. Most CPAs are trained to file the past or report the past, not build the future. And that's why I went deeper. I became a certified tax strategist and I studied for many advisory, business planning, and wealth structuring, trainings, because that's what actually changes lives. And I could do all of this because I had an amazing company of my sister, and we had the same vision, same mission. And with my sisters, I co-founded KB Tax Devisors. And today we own over 800 doors in multifamily units. And I mentor accountants across the country and run a seven-figure accounting firm, which is built under one mission: not just to file, but to guide, to protect, and to transform. And we have built a legacy in a family where women weren't even expected to finish the school. And now I get to help business owners stop overpaying and start building a legacy of their own. And now that you know who we are, let's talk about what we can do for you, right? So, at KB Tax, we work with business owners who have outgrown the file and hope model. File and hope, right? They don't want another tax preparer. They want a strategist who sees the full picture. We create personalized, proactive strategies that align with each client's values, goals, and the life they're building. This isn't a cookie cutter, it's designed around you. And our clients legally save anywhere from $30,000 to $300,000 plus year. And more importantly, they stop operating in the dark. They don't go to sleep with stress. And we have helped them reclaim over $65 million in silent overpayment, which would have been donated to the IRS otherwise, all with court tested ethical tax planning. And one client told us, when we saved him $112,000 a year in taxes, he's like, I finally feel in control. And that's exactly what we do. We give people their power back, financially as well as strategically. And what if you have been giving it away silently, legally for years? And, most of our clients come to us having done everything they were being told by their accountant. They work hard and, they built something real. They hired a CPA. They wrote everything off. Does this all sound familiar? If does, give me some messages in chat that this sounds familiar. But at the end of every year, they were still writing a massive check to the IRS like a loyal customer and feeling punished for growing, for having a business. Not because they did anything wrong, but because no one ever showed them they have to plan ahead. And we have helped hundreds of clients reclaim what they have been quietly giving away legally, silently, and for years. And one of the first things we ask them is, what would you do with an extra $50,000 if it was not going to the IRS? Drop it in the chat right now. What would you do with that money? If you had that extra $50,000 that you were unknowingly giving away to the IRS, what would you do? Let's see people's responses on this one. That's a lot of money, right? Maybe it's hiring for someone, maybe it's taking that big trip out, or maybe it's sending your kids to school, or finally catching your breath, right? For others, it's a building team, paying for college, or just taking time off. And for most, which many people don't even realize, it's a peace of mind. And we are here to help you get that back, peace of mind, because money will come and go, but the time is precious. And if we don't have peace of mind and you have lots of money, there will be still a lot of problems that's going to be there, right? So let's move on to, Courtney. She is not an exception. She's a proof of what happens when you stop leaving money on the table and start planning like a business leader you really are. So let me show you the framework we used to get her there. You know, she used to file taxes. She's, of course, just like you, she used to file taxes. She is a marketing agency owner who was doing everything right. She had strong revenue, she was working hard, and yet she still felt like she was just surviving. And her CPA, of course, was charging high fees, but giving no proactive guidance, met only after the end of the year. So we took a look and amended her prior return and found over $64,000 in extra overpayment just sitting there. We amended the tax return and got her a refund. And then we implemented a full strategy that saves her over $50,000 to $60,000 in taxes annually over the course of the last few years. And all this is done legally, ethically, and proactively. But here's where it gets really exciting. Courtney made some bold moves, and she used her savings to hire in-house HR and accounting department. And for those of you who knows about the marketing agencies, this is a big deal for them. First of all, most marketing agencies are heavy on contractor side, but she is an exception. She believes in her employees and she likes to, have her team being rewarded at the same time. She actually launched an employee equity plan last year, and she acquired another agency, and she moved her residency from California to Texas. When we first met, Courtney attended a live webinar just like you all are doing today. And when we first met, right after the webinar, she's like, Minal, I live in California and I'm just done with paying high taxes. I want to reduce my tax liability. I'm like, okay, I'm glad you mentioned about your goals. So I like to hear every single one of your personal and professional goals, because you never know what domino effect this can have, right? And her house was in a very good condition. She didn't want to sell the house. She wanted to buy another house and keep that house as is, because, she just loved it. She had lots of memories in that house. But either way, coming back, so last year actually she finally moved from California to Texas and to optimize her overall tax positioning. And here's the thing, going through the COVID years, she did not lay off a single person. In fact, she doubled her revenue. And today she's preparing for her company's future exit. And she's pretty young. You can tell from her picture, right? She's not reacting anymore. She's scaling with intention. And she told us, I don't have to be afraid anymore. I feel like I can weather any storm now. When you have right people on your side, right partners, especially on your side, you can weather any storm with peace of mind, right? And a lot more clarity. See, it's not, most people think, most business owners, most high net worth individual are always cursing and blaming the IRS, thinking IRS is a real problem. But the truth is, the IRS has given us thousands and thousands of pages of legal strategy to reduce taxes. The most people are blaming the IRS because CPAs are blaming the IRS. Their tax preparer is blaming the IRS, and tax preparer is blaming the IRS because they don't want to study thousands of pages of legal strategies. It's mind boggling, you know. They have created codes for credits, loopholes, deductions, timing structures, and yet most people never benefit from them. Why? Because they are working with a CPA who is still playing by outdated rules or doesn't know how to find and implement these strategies, you know. And honestly, a lot of these strategies we are not taught in our CPA curriculum anywhere. Okay, so I cannot even blame the tax preparers or CPAs. If my father had not had this kind of problems, then I would not have spent enough of time studying and, training myself in this area. This red flags, they are not just things you have said, they are things you have been told sometimes, you know. You only meet with your accountant once a year, or maybe there's nothing else to do, or your accountant tells it, you know, these are the problem of making more money. If you are making more, so pay more, you know. And your accountant is like, or maybe you are telling yourself, I deduct everything I can, what else is there, right? Right. um, and you know, all of this are all nonsense beliefs, let's say it that way, because that's not tax planning. That's not going to save you any money. That's called reacting. Okay. You know, you can't have an intention to lose weight and every day keep eating and keep postponing to work out and just magically think somehow you will lose weight and be fit, fine, and healthy. That doesn't happen, right? um, when it comes to giving one of your team member or employee any kind of a raise or promotion or bonus, you don't do that without reviewing performance. And when it comes to paying check to the IRS, which is one of the biggest expense for most businesses, you just write it without asking anything. You know, you don't even ask, what am I actually paying this for? And these are the patterns that cost business owners tens or even hundreds of thousands of dollars. And you didn't do anything wrong. You simply weren't shown what's possible. But what if that changed today? What if you had a strategic process, not just to catch the red flags, but to replace them with a customized tax strategy built around your business goals, around your personal life, around your future vision? And that's exactly what we are going to do in our time together today. And that's exactly what we do with Courtney Kill and, another client of ours, Dr. Madan, Mario. And that's the whole reason why I have built our own proprietary worthy method. So I'm going to go over some of this worthy method planning that we do for majority of our clients, as well as tax strategies. If you don't have anything like a pen, paper, or notebook to jot down any notes, I would say grab it right now, because this is something you don't want to miss out, right? Dr. Madan, let's meet Dr. Madan, who is a medical practice with allergy and respiratory specialist. Dr. Madan's story is incredibly common, even if you're not a doctor, okay? It's incredibly common among high income professionals. He wasn't doing anything wrong. He was simply doing what the IRS asked and assuming there wasn't another way. But the moment we layered in different strategies, IRS approved strategies called entity restructuring, Section 199A, or QBI deduction maximization, income shifting, timing shifts, and a lot of advanced tax strategies. And we reduced his annual tax liability by over $600,000. And instead of handing that money to the IRS, He's now investing it into real estate. And just literally earlier this week, he reached out. He's going to be a general partner, GP, in a multifamily unit deal. He didn't had this much of money before to take this kind of big investments. And now he already bought in December, he bought a short-term rental property, which was almost $1.3 million. And now he's going to be a general partner in one of the multifamily unit deal. And he could do this because he got a huge refund from last year. Plus, we knocked down his estimated tax liability every quarter. So this year, already 2 quarters have passed. He did not make much of the tax payment. Over I would say $400,000 saved, and that money he's investing in multifamily unit deal. And as he said himself, if I had met you 20 years ago, my wealth would look completely different today. And the truth is, he's not the exception. He's proof of what happens when smart strategy meets smart business. And now, let me show you how the strategic structure we use to help him and so many others unlock results like this. So let's go over 5 IRS-approved tax moves that saves $30,000 to $300,000 in taxes without changing how you operate. And yes, these are legal, ethical, and fully backed by the IRS tax codes and quote approved strategies. Most CPAs just don't use them because they don't know how to implement them. And it's safer to not use them when you don't know how to implement them because it may cause a lot of red flags and compliance issues. So let's go over the Augusta rule. And this is one of my most favorite tax strategy. You may have heard of it online. If not, you will hear it today. This is one of the most simplest strategy that IRS allows, and yet most CPA never use it because they don't know how to implement or they're just too scared not knowing how to make it work. And it's called the Augusta rule. It's designed per IRS Tax Section Code 280AG, and this strategy was designed based on the Masters Golf Tournament in Augusta, Georgia, where homeowners were renting their residences tax-free for up to 14 days during the time of the Masters Golf Tournament. So, in this particular strategy, if you run a business, especially an S corp, partnership, C corp, LLC, not the self-employed business though, you can rent your home to your company for legitimate business purposes. It could be like strategy meetings, staff planning, your team training meetings, could be content shoot, like if you're doing any content planning and things like that. It could be board meetings, it could be team trainings, a lot of these things, except you can't do any client entertainment meetings. Okay, that has been prohibited since the Tax Cuts and Job Act came in effect in 2017. Your business deducts a payment as a rental expenses, and you receive rent income personally. The homeowner receives the rental income, and that rental income is reported on the tax return. However, here's the key, which most accountants don't know. This income is completely tax-free under the Section 280AG. It's completely excluded from your tax return. And because the income is excluded from your tax return, you cannot deduct any expenses against this income, right? And when done properly with the market rate, fair market rate for doing business board meeting and things like that, you have a proper documentation and, proper invoicing or release agreement. This particular tax strategy can save you anywhere from $10,000 to $50,000 a year, completely tax-free, you know? And renting your home to your business, let's say if you're doing one business board meeting a month, at a $1,200 a rate, that's equivalent to $16,800 a year deduction. No taxes on this. And if you do this, this income is completely tax-free. As I said earlier, you need less distributions. or less draws from your business. Now, because this covers some of your expenses as well. Now, this tax strategy can be done in addition to your home office deductions, as long as you're using a separate room in your house for the home office and your Augusta rent. Now, if you're wondering why is the rental rate higher, this is not actually higher, it can be even higher depending on the state you live in and type of the house you have. Here's the thing. When you are renting the space just for personal use, the rent is lower. But when you're doing the board meeting and team meetings and things like that, it's automatically considered business event and things like that. So the rent goes very high. And most accountants don't do this tax strategy because they don't know how to create audit ready documentation. So if you have brought this strategy to your accountant, or if you're planning to bring this strategy to your accountant and your accountant just says, this is too risky or whatever, I wouldn't do this for whatever, ask for valid reasons. How many court cases they have studied? What is their valid reason? Are they saying it because they don't know how to create documentation and have to audit proof this tax strategy? Or are they just saying it for any obnoxious reasons? Most of the times, accountants turn down the strategy that you bring to them because they don't know how to implement them. So, but someone has to do the work, right? So let's go over the next one, which is a QBI deduction. And let me tell you, this is one of the most generous tax strategy available, and it can help you deduct up to 20% of your business's net profit or income completely tax free. And yet, many people don't plan for this particular tax strategy properly. And with this new big, beautiful bill act coming in, this has been, made permanent. The QBI deductions have been made permanent. So we will be able to take the deductions for QBI even moving forward. And it's one of the tax strategy is the most misunderstood and most underutilized. You know, the calculations for the QBI are a little bit complicated, and that's the whole reason why most accountants neglect to plan for the QBI. Most business owners are focusing heavily on maximizing deductions than maximizing QBI deduction. So they are focusing heavily on deducting their expenses and whatnot rather than QBI. And let me tell you, if you plan properly for the QBI deduction maximization, even if you're not deducting whole bunch of nonsense expenses, your business will be far ahead when you get 20% deductions just with the QBI. And what I'm talking about 20% is a 20% of your net profit. Of course, there's a formula which goes sort of 25% of your salary, all the salary paid through the company and whatnot. But most CPAs don't go deep enough to restructure your payroll, your entity, your owner's compensation in a way that unlocks full QBI value. And especially after the big beautiful bill clarified stricter guidelines on losses and compensation, this is going to be even more important tax strategy. And here's what, as I told you earlier, what we have seen, most business owners are trying to deduct everything and automatically gets disqualified from the QBI, unfortunately, right? So high earners overpaying self-employment tax and missing the deduction. Instead, we should focus on optimizing your income types, balance your pass-through threshold, and layer your structure so that QBI becomes a permanent part of your tax reduction story. And yes, even if 2024 has passed already, you may still have time to adjust and capture some of this savings before your next quarterly estimated tax payment. So every quarter, you have to plan in advance. How can I keep my taxes low? And, thoughtfully plan your expenses, your investment, and spending in a way that's going to give you higher return for your money. The amount of time we as a business owner spend in training our teams, creating processes, fine tuning our products and services, if a fraction of that time we spend in our tax planning, a lot can be changed. I'll give you an example. If a business owner with a $500,000 net profit from the business could get up to $100,000 in QBI deductions. That's a lot of money, right? And that's what many people are leaving on the table. And this one goes hand in hand with the QBI, so I'll take it right now. S Corp salary strategy, which helps you minimize your taxes, maximize your QBI, and also stay audit proof. This is where lots of CPA get it wrong. They either guess your salary or keep using the same number year after year for no rhyme or reason. But IRS doesn't accept what feels right. They expect reasonable compensation, which is based on your role, your industry, and the time actually spent working in the business. So if you pay yourself too little, you risk penalties. And there are court cases I have personally studied where IRS have reclassified 100% of your distributions as your salary, and there is not a single court case where taxpayer has won against the IRS on that situation. So if you're paying yourself too little of a salary or no salary at all, IRS can come back and reclassify your entire distributions as wages and salary and charge you penalty and interest on the payroll taxes. Now, if you pay too much, then if you overpay too much in salary, you're overpaying in payroll taxes unnecessarily and may lose your QBI deductions at the same time. Think about this. If you have $100,000 to, let's say $200,000 instead of $100,000, if you're paying yourself $200,000 in salary, okay? You rather do combination of 100,000 salary, 100,000 distribution, or multiple formula, again, which is based on your role, your industry, the time you are spending in the business, different hats that you wear as a CEO of the company, because you don't wear just one hat, right? You wear multiple hats. Now, if you're overpaying yourself in salary, then that $200,000 times 15.3%, which is all the combinations of payroll taxes, whether we call Social Security, Medicare, unemployment, all of that is what is wasted in payroll taxes, which doesn't come to you, doesn't stay in the business, goes in straight payroll taxes. Now, I rather have you take that full $200,000, right? Why would you pay that 15.3% in tax and then take that wages at home and pay taxes again on that wages on your 1040? So, we run annual reviews and reasonable compensation study based on the IRS guidelines and based on the similar industry benchmarking and your current business phase where you are, and your salary is strategically designed. It's all documented. So even if we get the IRS notice tomorrow, we show here's how we came up with this particular salary. When was the last time you sat down and you wrote down every single rationale? How did you come up with your salary? If you don't have that and you're just paying yourself X number of salary, IRS is going to challenge that. And that's not a strategy, that's a liability, in fact. And when we do these things right, you save thousands, stay off the audit radar, and unlock bigger deduction that most CPAs never talk about. How are we doing so far? I hope these strategies are making sense. And if you have any questions, make sure to post those questions in the comment box or in the Q&A section, and I'll make sure to cover all of those questions towards the end of the session. How grouping passive and active activities can lower your taxes. Many business owners or many high net worth individuals want to step into real estate. They hear all this all over the places when they are going to the conferences and whatnot, passive and active and whatnot, right? So grouping activities under Section 469 is one of the most underutilized yet powerful tax strategies for business owners and real estate investors. And if you own a business and also own the building, that your business operates from that particular business, you can combine these activities for tax purposes under Section 469. And this allows you to offset passive real estate losses against your business income, resulting in significant tax savings. To give you an example, for an HVAC business owner with thriving S corp and a rental property under a separate LLC can group them to deduct the real estate losses on the tax return. You don't have to have both in the same LLC. It could be both separate LLC. It's just this grouping election that your accountant needs to make when they're filing a tax return. And grouping must be elected when filing a tax return. It cannot be added later on by an amendment. I know that's kind of not fun, but certain tax deductions and strategies are lost forever if not done with the original tax return. And that's why this kind of really makes proactive planning really critical. You know, the one of the most overlooked tax strategy I would say is the triple tax-free HSA strategy. Most people think of HSA as a medical only account, but honestly, HSA is far better than your 401k account. Most people are familiar with the 401k, IRA, simple IRA, but this is far better than that. What they don't realize is this. It's the only account in the tax code that's triple tax free. You deduct on the way in when you are contributing into the HSA account. It grows tax free when you invest this money. And when you withdraw it for the qualified use, it's completely tax free. The 401k, when you invest, it's completely. It's a pre-tax, so it's tax free. It grows tax free, but you have to take out minimum required distributions. With this, there is no compulsory minimum required distributions. It can accumulate year after year, and the new tax law, Big Beautiful Bill Act, makes it even more powerful. Married couples over 55 can combine catch-up contributions now, and contribution limits have also increased up to $8,550 per year for a family. And the even more beautiful thing, you can now roll over from your FSA or HRA, which we never had options before. So you know, the best part is after the age 65, you can use your HSA for anything, not just medical. And you don't even have to pay any penalty. You can pay for your long-term insurance premiums, long-term care insurance premium, a lot of other things. And that's why we don't just help clients open an HSA, we help them build a long-term wealth and a retirement strategy around it, because the IRS actually wants you to benefit from this. And that's the whole reason why these tax strategies are actually designed, right? The next one, how do we approach Big Beautiful Bill Act changes? There are a lot of things that we can take immediate actions in 2025, like energy credits, car purchases. Especially if you're thinking about car purchases, consider an American made vehicles for higher interest deduction. Tips overtime planning, if you have any employees or where you're giving them tips or overtime, this could be a good planning to think from that point of view. And of course, HSA planning, which we discussed earlier. And for 2026 year and onwards, we have QBI deductions. So up to 2025, we have had QBI deduction at 20% of the business income. And that's going to be increasing actually next year. So that's even better, 23%. And we have higher SALT relief on the state tax deductions on your 1040 Schedule A. We had a limitation of $10,000 since the Tax Cuts and Job Act came in. And now it's going to be $40,000 deduction limit. So that's going to allow you to deduct higher taxes on the business, personal side. Estate planning, where we can leverage about 15 million exemption increase, and business equipment. where we are going to get 100% bonus depreciation deduction through 2030. That's a lot of, big changes. Of course, there are R&D tax credit changes and a lot of that. But given the short amount of time, and when we announced this master class, we did this big beautiful act did not come in. So I just wanted to kind of stay true to that and also cover the strategy that's going to still remain in place, whether without the big beautiful act or with that act coming in. And in our next webinar, I'm going to dive way deeper specifically on the big beautiful bill act as well. And the biggest tax mistakes that business owners make and have to fix them is many business owners think they are saving on taxes, but in reality, they are unknowingly making mistakes that cost them thousands. I was talking to another business owner the other day, and he's like, I'm renting the house right now, and because I'm working virtually, I pay my rent 100% directly from the business because it's a business. And I'm like, okay, and how much rent are you paying? And he's like, $2,000 a month. I'm like, okay. Is the IRS requires that the space is used for reasonable and necessary amount of time for business purposes. Now, are you utilizing that space to sleep? He's like, yes. Do you have another place to go eat your food or, spend your personal time, watch TV? No, he's like, I do everything from home. Then that's not the business use space. For home offices, IRS requires that the space is used exclusively and regularly for the business purposes. Now, $2,000 times 12, if we do the math, that's $24,000. If this person is in a 35% tax bracket, that's $8,400 worth of tax benefit. It's not worth it to cheat the IRS on something that we know is knowingly unethical, and we cannot stand behind this particular strategy, right? And many people do this unknowingly, okay? One of the biggest mistake is creating unnecessary business losses, which disqualifies them from valuable QBI deduction. Not optimizing your business entity. You're just operating in a business entity that previous owner had for whatever reason, or, you know, what we call, you have seen everyone operating under the S corp, so you bought a real estate under the S corp. That's not the right strategy, because buying a real estate property under the S corp is one of the worst entity type to have. You know, the other thing could be, not optimizing your business and you're paying excess self-employment taxes. So these mistakes can be easily avoided with proper proactive planning. So let's talk about, how do we fix them? And before we talk about how do we fix them, let me take the case study of Mario. He had been with the same accountant for 13 years. And in fact, his accountant was one of the family member. But Mario was constantly stressed about high tax payment. Even though he was paying accountant few $100s for tax preparation, his accountant was not doing any tax planning, which resulted in overpayment of $48,000 a year in taxes. And if you do the math, $48,000 times 6 years, that's over $293,000 in cash that should not have been lost. Even in the economy where we are, you can still buy a real estate property with $293,000. Mario did not like that accountant anymore. And few strategies that we utilized in his situation was entity optimization, hiring his kids in the business, Augusta loophole, captive insurance, and retirement strategy. And first year tax savings of $48,000, 5-year tax savings of $244,000. And if you look up our business, KB Tax Devices, Google review, and you will find Mario's testimonial on there. This is a powerful impact that the tax strategies can do. So let's talk about the worthy method. This is our strategic framework we have used to help all the clients like Courtney, Dr. Madan, Mario, and we have saved our clients over $65 million, protect their peace of mind, and finally take back control from the IRS and their CPAs. And that includes people just like you. business owners, consultants, real estate investors, high net worth individuals, even people who were already working with the CPA they trusted, but still felt like something was missing. And maybe you have felt that too, right? So, W here stands for write your financial story proactively. And before we even touch any kind of a tax form or a spreadsheet, I like to start with your vision, the freedom, the peace, legacy, your values. What really matters to you? What are your goals? What do you want this business to create for you, for your life? Whether that's peace of mind, more time, a path to freedom. And we start with that. And then we build your tax plan to support it. And that's where it leads us to the next stage, which is O for optimizing. Optimize your entity structure, your deductions. This is where we legally reduce your tax burden by looking at your entity, income type, deductions, credits, and the most importantly, timing. Because strategy implemented too late still hurts your bottom line. And if you implement it too early, it's still hurting your bottom line, right? The next one is R, where we reveal what's been silently costing you. We go back and review last 3 years of your business tax return, personal tax return, your overall current setup and your previous filings, and the overall strategy you have in place. And this is where many of our clients find $30,000 to hundreds of thousands in silent overpayment that they never realized they were losing, not because their CPA was bad, but because their CPA was not strategic. And now we have uncovered the problem, let me show you how we secure the solution. Once we have done the WOR, the next three steps are implement, protect, and grow. And after we have revealed what's been missing and design your custom strategy, T is where it becomes real. T is for tax proof, prepare, and report with confidence. We implement your strategy, we prepare your return, and we ensure that every move is IRS compliant and audit ready. And this is where the savings you planned for, are actually being realized with no guessing, no loose ends, right? And the next one is H for harmonize, protect, and preserve your wealth. We help you protect your wealth and preserve it for what it truly matters to you. Maybe that's your next business, your retirement, your lifestyle, your family structure, whatever it is. Your tax plans need to align around you. And that's exactly what we do. And finally, that leads to Y, which is for year round support and strategic optimization. This is the part that most clients tell us they have never received from their previous accountant. We don't disappear after tax season. We are in your corner with the quarterly reviews, real time adjustments, and measurable tracking. So your tax plan evolves as your business grows. For every single one of our clients, we review their reasonable compensation and salary from the business at the list twice a year. Because, as your business continues to change, shift, and as your personal life continues to evolve, it's very important that we stay on top of it and we plan ahead of the time. Because clarity doesn't come from crossing your fingers once a year. It comes from partnership, structure, and ongoing leadership. And this is what changes everything. Because when your tax plan is built around your values, implemented with precision, reported correctly, and updated as you grow, that's when clarity becomes power. And that's a worthy method. So, how we work again, based on the worthy method, we kind of sit down and design your tax plan, implement the tax strategy, give you audit ready documentation, help you create the audit ready documentation. Every quarter, my team calculates tax projections, review all your implementation documents so that we stay current. And again, after that, we adjust any projections if we need to, add more tax strategies if we need to on a quarterly basis, and file your return at the end of the year and begin implementation for future year strategies. So who is a good fit for all of this tax strategy is someone who is filing as a single or married filing separate, income above $300,000, or if you are, doing married filing joint with the income above $400,000. We have these differences in the income level because of how the tax bracket really works. It could be any income from all the combined sources, could be W-2, business profits, interest, dividend, capital gain, all of that. You know, those are the right people where you are in a higher tax bracket and you can save money on taxes and make a difference. So, if this is of any interest to you, as a favor to all of our participants today, we are going to offer a free tax analysis only for 10 participants. Let's figure out how much you are overpaying and book your free tax analysis, using the link that's posted in the chat box. Um, so at this point, if you have any questions, we can go over those questions and kind of go from there. So I see we have a message from Kuyen. I hope I'm not mispronouncing your name. Your business is in real estate, rental, and export income, and you need our support and expertise. Okay. If possible, can we schedule a new client indexation? Absolutely, Quen. Feel free to schedule the session from the link in the chat box. And, I will see you in that meeting. If we can help you, we would absolutely love to help you on that side. If we cannot help you, I will tell you very honestly, transparent, because I don't like to give you wrong hopes. I have another question. Um, okay, let's see. Heidi or Taruna, can one of you put the link in the chat box for me, please? While I take on the next question, I have anonymous attendee here. I want to know about what savings from new tax bill. That's something I'm going to definitely go deep dive into my next webinar. Today, I kind of little bit scratched the surface because that new tax bill came in, but stay tuned. I'm going to be definitely be covering much more deeper in my next webinar, specifically on big beautiful bill. So I'll make sure that, if you have your email address, I'll make sure to let you know as soon as we have the date finalized. The next one is Stephanie would love to use your free tax analysis. Absolutely, Stephanie, feel free to reach out. What's a strategy you would recommend for high W-2, no kids, married filing joint? So this is a question from anonymous attendee. I'll tell you. Remember, you saw the case study of Dr. Madan. He had a practice. He had a wife who has a W-2 income and whatnot. But his brother, actually, he referred his brother. His brother is a physician. Wife is also a physician. Both have six-figure W-2 job. And we still did a lot of, I would say, at least 3 to 4 sophisticated tax strategies for them, which helped them knock out 6 figures in taxes between the husband and wife. So we do have lots of strategies, even if you don't have children's, or if you have children's, your children's are younger and they're like, okay, anyone less than 10, 11, 12 years, I don't think they can do anything in the business. So we want to hire the kids and do things which can be legitimately correct. So that's kind of there. Hi, thank you, Heidi, for sharing the link in the chat box. I have one last question. How do I know how much I can save? So here's the thing. When you are scheduling a meeting with our team, in that scheduling link, there is a link to the secure portal. You can upload a copy of your most recent tax return. It could be from 2023, 24, 2025, doesn't matter. You can just, let me see. you can post I'm sorry, what you can upload your tax return, and when I have that tax return uploaded, I will review it, and when we meet together, we can go over, how much we can save you in taxes. That's something we tell you for every single, client before we take on anyone. um, so I have another one. How do I get consultation? I'm expecting about $2 million in income this year. I hope it's not too late. Also, I didn't file 2024 taxes. Can you help save for 2024? Um, so this is an anonymous attendee again. I don't see your name, but schedule the consultation call. If your 2024 taxes are not filed, in fact, it's kind of a good news. So, we may have some opportunity available. If not, I will be very honest and tell you honestly, because I don't like to give people wrong hopes. I know how finances can be sensitive for people. So, Heidi, can you make sure to share the link again with Brad Patel? Because I see you have some sent link with the Priscilla and all of that. So that's there. You don't have to have business. You don't have to have hired the kids. We have plenty of tax strategy. What we went over in this masterclass today were most of them tier one tax strategies. There is tier two, tier three tax strategies as well. Very, very advanced tax strategies. There are certain tax strategies which we can only implement if you have more than $1 million income. If less than $1 million, we don't even take on client. So, and you don't have to have a business. It could be a W-2 wage earner as well. So, be rest assured, we have strategies for every single one of the situation. And I and my sister, Taruna, we are constantly evaluating more and more tax strategies. And, and this is a passion of ours. We just like to be really creative and understand what really moves the needle and makes our clients really happy when it comes to strategies. So that's where, you know we are always looking for more options, and we have lots of varieties and options right there. So Raki, yes, ideally that's what is our comfort zone, anything above 300 to $400,000. However, if your income is a little bit lesser and you just want to kind of schedule a call to get my insight, I'm more than happy to guide you, especially because you just came in and attended the call, joined our master class today. If I cannot help you, I will have another referral for you. So be rest assured, there will be one or the other option available for you. Alrighty, well, thank you so much, everyone, for all the questions. If by any chance I missed any of your questions, please feel free to send me an email, or give me a little bit of a time, and I will make sure to get back to you with all of those questions. um, Thank you so much for attending today's masterclass. We are planning to host webinar or masterclass at least every month, one masterclass a month. If there is any topic that you would want me to cover, just send us some recommendations and suggestions, and I'll make sure to cover in one of the next master classes. Okay? Thank you so much for your time today. I hope you learned something new and this was very helpful for you. Stay tuned and enjoy the rest of your day. Bye bye, everyone.